Good morning here in New York City. I am Erik Schatzker, editor-at-large with Bloomberg Television, and delighted to present to you here at Bloomberg Invest Global, Dawn Fitzpatrick. She is the Chief Executive Officer and the Chief Investment Officer at Soros Fund Management, the first person to hold both of those titles at Soros. It's always great to have you here, Dawn. Good morning.
Good morning. Thanks for having me, Erik.
Dawn, I'd like to start our conversation by talking about inflation. Europe is having a proper energy crisis, and so is China. For those who haven't noticed, oil is at a 7-year high. U.S. natural gas prices have more than doubled year to date. Industrial metals are ripping at the fastest rate in more than a decade. Is this really a transitory phenomenon?
So first of all, I think on the energy side, it's largely a political phenomenon. I think Russia had a vested interest in natural gas prices being high in the context of Nord Stream 2 approval. And in the context of China, I think their decision around Australian coal,
which is to say not to buy anymore?
Not to buy anymore, to put them in the penalty box. You know, what they failed to realize there is even though the majority of their coal is domestically produced, things turn on the margin. So while both of those, I think, are geopolitical causes, I think the interesting thing is when you look forward, high energy prices or high fossil fuel prices is not necessarily a bug of ESG, but it's a function.
An accelerant?
And it's by design that you will promote transition to cleaner energy with higher fossil fuel prices. So while not the cause here, I think when we look forward, this is going to be the new norm where you see spike in energy prices. And it's something I think we have to get used to. To your question on inflation, you know, I think we've all been surprised at kind of how long this feels like it's going to last now. And the other interesting thing is, you know, a lot of this is supply side inflation. And it's not clear that monetary tools really deal well with supply side inflation. And I think the risks are that this can become self-reinforcing. And again, that's something that we're relatively focused on.
So to the degree that you try to predict in the positions that you take what the Fed is or isn't going to do, if we are talking about supply side inflation and monetary tools, as many central bankers, including most recently Andrew Bailey of the Bank of England, have explained, right, that they're built for the demand side of the equation. What do you think the Fed will do?
So I think the Fed is lucky because the U.S. consumer is in a good place and employment feels like it's really heading in the right direction. So, you know, I do think we'll get the tapering announcement at the next meeting. And I think what was interesting is the speed of tapering. Obviously, it caught the market a little bit by surprise in that they said they'd be done potentially with tapering in the first half of the year. So I think the market liked that the Fed is maybe going to be less far behind. But by the way, if you watched gold in September, it was down 5%. So I think you know, the fear of the debasing of the U.S. dollar has receded to a degree. Also, by the way, the IMF just came out with kind of reserve currency balances, and the U.S. dollar has stopped losing ground.
Yet Bitcoin's at 50,000.
Yep, Bitcoin's at 50,000. So I think that's the really interesting thing, is that you know, I'm not sure Bitcoin is only viewed as an inflation hedge here. I think it's, you know, it's crossed the chasm to mainstream. It's, you know, cryptocurrencies now have a market cap of over $2 trillion. There's 200 million users around the world. So I think this has gone mainstream. From our perspective, again, more than we own some coins, but more than not a lot. And the coins themselves are less interesting than the use cases of DeFi and things like that.
Let's go back to inflation for a moment. To the degree that you think it's going to last longer than people initially expected, what sides of that trade are you playing? Are you playing sort of the classic, you know, treasury side of the trade, commodities or commodity volatility, or stocks, you know, that potentially face margin pressure?
So we've been long some commodities, and we are short government bonds, not just in the U.S. Again, real rates are really negative right here, and I think it's a reasonably safe bet that rates are going to go higher. I think the one counter to that, and something that's worth watching, and I think checked the rate move last time, is bank deposits keep going higher, and they're just at an enormous level. So the amount of bonds banks need to buy on the other side of those deposits is enormous, and that will a little bit counter check, any material move higher in rates, and it's something that's worth watching, and you might want to trade the ranges here.
What if we're heading into a stagflationary period, right? It's a word that people in the market are using more and more and more, and not for me to say whether we are or whether we aren't, but is there a stagflationary trade?
Yeah, so again, I would hope that we're not heading into a stagflationary area
from a human interest standpoint.
But to your point, it's gone from like not being a word that's common in our industry to being front and center. I think the one counter to that, though, is coming into COVID, one of the things that we were really struggling with was productivity. And while right now you see kind of wage growth trend clearly kind of firmly in place, and I think wages are going to continue to have upward pressure, the offset to that is potentially productivity, where you're really starting to see some sustained gains. And I think that is ultimately going to be the counterbalance, and really, really important to avoid stagflation.
The other thing people keep talking about, in addition to inflation and stagflation, of course, is what on earth to do about China. There's been this dramatic shift in domestic policy and regulation, right, for the private sector, with seemingly huge implications for investors who have made so much money on the backs of billionaires like Jack Ma, for example. And then meantime, the United States is trying to squeeze, the Chinese by cutting off supplies of critical semiconductors and software. Is China a buy or a sell?
So China, by the way, China is incredibly interesting at this at this moment in time. So if you think about where they are, they had residential investment, depending on if you count just first order or first and second and third order, something around 10 to 29% of GDP. But they have a shrinking population. So that is definitively unsustainable growth. So if you think about what Xi is trying to do, he's trying to rebalance his economy. And by the way, in a way that I don't think you or I would argue is not smart, but the way he's going—
In fact, he's trying to do some of the same things that people here would like to do, but just find incredibly difficult because they're so, politically divisive.
By the way, 100%. I have no doubt that there's politicians around the world that are jealous about the degrees of freedom that Xi has. But I think that what's caught kind of Western investors by surprise is kind of the step function fashion he's doing it in, and the economic damage he's willing to tolerate to get from here to there. And as an investor, I think one of the things is, based on what's happened the past couple of months, it's pretty clear, every Chinese company is viewed to be a state-owned enterprise to one degree or another. The other thing, I think, from an investment perspective that's really interesting and that's gotten a lot of attention from Chairman Gensler and others is the VIE or shell company structure of Chinese companies that are listed here. And, I think that those companies will largely have to delist. And by the way, for a lot of them, there's a mechanism for them to just port to Hong Kong. But, for 20 years, Chinese tech companies having Western capital and a Western vested interest in their success very much suited China's goals. They don't need that anymore. So they can take their $700 billion and take it back onshore into Hong Kong. And I think that's what they're going to do. So when it comes to the U.S. Chinese listings, if I were investors, I'd be really careful here.
What about earlier stage investments, Chinese venture capital, for example?
So again, I think it's going to be a while before those have an avenue to go public. There's some really big names that might go public near term in Hong Kong to make a point. But I think overall, that path from private to public in China is just going to take longer. And valuations, I think, are permanently at lower multiples because of effectively the state tax and state utility.
That sounds to me, Dawn, like potentially a big problem for firms like Sequoia, for example, or Tiger Global that have done so well investing in early stage Chinese enterprises and then, riding their evolution to the public markets.
So nobody's going to cry for Sequoia or Tiger Global, and I think they have plenty of dollars outside of China that are doing extraordinarily well right now. But my guess is there's a lot of debates going on in their boardrooms about how aggressively to invest going forward. The other thing I would say about the asset management industry overall is that they're a little bit economically compromised. China has invested a lot of money in Western asset managers, so it's hard for them to take too hard a stance when it comes to forward investments.
Are you allocating toward China or away from China?
I would say we are not putting money into China right now.
Now, I mentioned Sequoia and Tiger Global. Those firms are emblematic in a way of the shift of money that we've seen out of public markets and into private markets, from liquids into illiquids. Now, Soros Fund Management plays both sides of that equation. Given the extraordinary returns we've seen, endowments, right? Endowments are not known for producing 50, 60, and 70% annual returns. And yet that's what we've seen because of the allocation they have to some of these fast-growing private market investments. What are the implications of that?
So I think this is an incredible moment in time. To your point, 2013 there were 39 unicorns. Today we have 840 some odd unicorns. You've seen obviously companies stay private longer coming into this year, and then all of a sudden you had the Fed, go extraordinarily low with rates, and what happens then is effectively your high growth stocks, the discount rate is close to zero, valuations go through the roof. So you had this enormous pool of private companies that now have decided to come public at an opportune moment in time. And to your point, it's driven just these extraordinary returns, but it's also going to create an asset allocation problem to a degree for these big endowments. First of all, you saw kind of public market funds start to go into private markets, last couple of years. Now, all of a sudden, because of this IPO activity, private fund allocations have a large amount of capital that's effectively in public markets. And what happens then is they're going to crowd out. It's like squeezing a balloon. If the typical endowment, they say they're 60-40, but they're actually probably 75, 25 or something like that in reality. But now, given these markups, that has gone even further. So, call it 90-10, and maybe it's 90-30 because there's a degree of leverage in there. What's going to happen is they're going to have to redeem from their traditional public managers that have net exposure. So your long onlys and your hedge funds with 60-40s are going to be under pressure, because when those asset allocators sit around a table, the private equity guys, their returns look better both on an absolute and kind of value add perspective. And if you don't allocate to the next fund, you lose your spot in line. And everyone lives in fear of that right now, given the returns they produce. So I think there's going to be some really interesting conversations around those investment committee tables of those endowments. And net, I think active managers in public markets will get squeezed. The people who won't get squeezed are the big multi-strategies that run low nets. So I know you interviewed Ken Griffin yesterday. He'll do just fine. He actually might be a winner out of this.
what are you doing? Right, you have a choice to make. You unlike an endowment, don't feel the same kind of pressure to chase those beautiful historic returns. Right, you can be more dynamic in your allocations. Are you putting more money into private markets? Do you feel comfortable with your public market exposure? And what vehicles, do you prefer? Direct drive, hedge fund, private equity, venture capital? What appeals to you?
Yeah, so we've been running more and more money internally in public markets. We feel like there are some advantages we can play to. And when we look at private markets, one of the things we've been doing more and more is trying to have partnerships with those corporates where we can be solution across their capital stack. So we're not just providing equity. We might provide a warehouse. We might provide a line of credit or straight debt. And I think being able to provide kind of that spectrum of solutions in aggregate, you get better access and you become kind of a more valued partner.
Now, you're going to face a decision at some point in the not too distant future because one of your probably best, I'd have to imagine, private investments is the stake that Soros Fund Management has in Rivian, right? The EV maker or EV pickup truck maker, or truck maker, let's say, backed by Amazon, also backed by you, that's going to go public, perhaps at a valuation of $80 billion. Are you a long-term holder, or are you going to crystallize some of those gains?
I think my compliance people might yell at me for talking about this, but we think that is a great company, and candidly, we hope they come public at a little bit cheaper than that, because we want there to be a long-term value play there.
You want other people to fall in love with Rivian.
Yeah.
And one thing I haven't asked, again, just emphasizing sort of the freedom and the dynamism that you can put to work at Soros, is whether the recent, we're approaching correction territory for U.S. stocks, whether that has, whether you felt inclined, looking at where valuations were, to dial up your cash allocation, or whether that's something that feels more appropriate now.
So we have been building back up our cash allocation. Last time you and I talked, back in March of 2020, we quickly put about $5 billion to work, and over the past 18 months, we've been building back up that cash buffer. So right where we sit today, if we had a next crisis, we could put another $5 billion to work in pretty short order.
That's pretty large. That's close to 20%, right?
Yeah, we use leverage. So again, because we own a lot of the public securities directly, we have the ability to borrow against those securities. So we have degrees of freedom. I think the typical endowment and foundation doesn't have. And again, we try to use that to our advantage every chance we get. In terms of where we are in the cycle, we are definitively late cycle. But one of the best trades this year has been selling vol. And it's because there's not a lot of places to go in a regime like we're in now, where, as I mentioned, rates are very negative in real terms. Corporate spreads are really tight. So I think you still want to own equities. I think you can take a little profits off the table, and as I said, build up liquidity. So that if we do get a kind of a misstep, you have room to lean in. I also think it matters where you are. So if you look at the Hang Seng on the year, it's down 13%, while the S&P is up 14%. So dispersion across countries and across sectors is enormous.
Dawn, we have about 30 seconds to go. I'll take this opportunity to ask you for one or two of your highest conviction bets.
So I think recovery stocks are still too cheap.
Really?
And they should be bought here.
Why? How's that possible? Given what we've seen transpire over the last 18 months.
So if you look, and this goes back in part to the productivity issue, these companies have learned to do things better. And I think when you look at the U.S. consumer, they are flush with cash and they want experience, not goods.